Welcome back to the Commercial Real Estate Show. I'm Michael Bull. Today we're talking multifamily. We're going to look back at 2016 and look ahead to 2017 to see what to expect. Please welcome my next guest, is Stephen Marks. He's managing director with Fitch Ratings. Stephen, thanks for joining us on the phone today.
Michael, thank you very much for having me.
Well, Stephen, how did multifamily REITs perform in 2016?
Was a good year in many ways. The sector outperformed pretty much all the other asset classes when it comes to the primary performance metric that we look at, which is same-store NOI growth. And it was, for the first 9 months of the year, it was roughly 5.5%, which outperformed the market pretty handily.
Nice. So multifamily REITs outperformed the other REITs?
They did from a performance standpoint. Now the stocks haven't done so well, which kind of leads into 2017 and our thoughts about that. And given that the stock market is more of a forward-looking measurement, as are we, it's going to be more of a tricky year, probably more of a transitional year for multifamily heading into 2017. In general, the backdrop as we see it is that the cycle has been quite strong despite above-average supply. And the way we think about that and why we think that's happened is that constrained single-family mortgage availability has been the predominant factor driving the home ownership rate lower, and multifamily has been the beneficiary of that incremental demand. But now I think we're at a point where supply is beginning to equal and perhaps overtake demand, such that while we still think 2017 is going to be positive from a same-store NOI perspective, some companies may be closer to zero than 5%.
I see. It seems like we always think that multifamily's just been doing so well that it's got to slow down. But I guess the growth, the improvements are slowing down a little bit in the fundamentals. But I think you mentioned something very interesting there in the affordability of buying new homes. And so we're also going to see some interest rate increases in 2017, right? That's expected. So what should that do to multifamily REITs?
That might actually act as a buffer to benefit multifamily to the extent that a mortgage, first mortgages need to become more available, and that really hasn't changed. Increase in interest rates will make buying of a home incrementally more expensive. So that on the margin will probably either keep people renting or maybe be a disincentive towards buying. So that might actually be one thing that kind of offsets some of the supply coming on is more challenging financeability of a single-family home. Right.
So to be more specific, for multifamily REITs in 2017, what do you expect them to do?
We still think it'll be positive from a same-store NOI perspective, but less than how they have performed or how they did perform in 2016. So we're thinking probably somewhere in the low single-digit growth, which will be one of the lowest numbers that the sector's seen really since the end of the crisis.
Right. And are multifamily REITs considered any more stable than some of the other REITs? It seems like when we're working with investors directly with these REITs buying the multifamily properties and private investors buying them, we get a sense from them that they feel multifamily is just sort of stable, that if the economy takes a dip, that people still have to live somewhere.
That is one of the things that we've looked at, and we've looked at it from a couple of different perspectives. One is just that housing is a human need. People either need to live in an apartment or a single-family house, whereas other forms of commercial real estate are not, by definition, needs, that they're wants, whether it be office or retail and industrial and so forth. So that acts as a supporting element to the underlying fundamentals. Number one. Number two is just on the financing side of things. You've got the GSEs, right, Fannie and Freddie, that their mandate, their charter is to act as a counter-cyclical source of liquidity to the multifamily market in particular. So to the extent that CMBS or insurance companies or the debt market generally, that every other commercial real estate class has to access, if for whatever reason those markets just really aren't functioning well and companies can't get capital, then the GSEs step in And we saw that happen in a really meaningful way in 08, 09, 010. And so that is always going to also act as a support buffer to values, is that you've got the GSEs there for this sector, whereas other sectors don't have that.
That's a very good point. We're talking with Stephen Marks with Fitch Ratings about multifamily REITs. And Stephen, is there anything in what Trump's saying that he's going to do that could impact multifamily REITs?
Probably not. Broadly, some of his policies have addressed the elimination of or reduction of taxes, corporate taxes, which may make other forms of corporate investments, corporate industrial companies, a little bit more attractive, because the REIT tax advantage becomes a little less meaningful when other companies are also paying less tax. That might be one thing. On the flip side, there's also speculation that he may eliminate the interest tax deductibility across corporate America, which would make it challenging for real estate companies generally and multifamily specifically, because they are such big borrowers and do incur meaningful amounts of interest expense, to the extent that that's no longer deductible for taxes, and hence REITs would need to pay out some of that income in the form of dividends. That could create some mismatches in terms of cash flows.
That's interesting. Stephen, what do you think about affordability? It seems like the rents have really increased pretty quickly over the last several years around the country for apartments, but yet incomes really haven't increased that much. Is there some concern for affordability when it comes to keeping these apartments full at these higher rates?
It's definitely something that we're looking at. You can only push so far. If incomes are rising at a slower rate than rents, that's not sustainable. And there are, in particular, some markets where we're actually seeing that happen. In New York City, for example, and San Francisco, where there's been a lot of supply and demand has not been as robust in those markets as perhaps some of the developers and owners were hoping for. And in some of those cases, we're actually seeing rents going negative from a growth standpoint. And so it sort of ties into your question about how much can you push rents. Well, you can only push them until you no longer have two people that want that same apartment unit. And when you don't, then rents need to go down.
Right. And then you also just mentioned supply. So what do you guys think about the amount of new supply in the multifamily world and its impact on REITs?
It's up when you look at overall supply coming online relative to in-place stock as a good sense of kind of the incremental supply coming on. And it's up. It's up, but it's coming down in general. I think there's been an acknowledgement that maybe the sector is beginning to slow, and that next incremental buyer or renter is maybe not there or as robust. And so we've seen a general pullback in development spending by REITs, and in general, I think 2017 might be or 2016 or 2017 may be the peak years of development deliveries, and then we expect there to be a slowdown.
I see. A quick tip before you have to go, Stephen, for the multifamily folks?
Be careful. I mean, this is a year of transition, and so while fundamentals have been good, the market and we are forward-looking, and it's all about what does the future hold. Can demand kind of keep up with this strong amount of supply that's been coming on? Can companies still continue to push rents? We don't think so. We think this is going to be a year of transition. Having said that, for REITs in particular, they have delevered way more than other sectors. They've got tons of liquidity. So in that sense, to the extent there's some weakness or some downside on fundamentals, they're well protected from a credit standpoint.
Good advice, Stephen Marks. Thanks for joining us, and stay tuned for more on the multifamily market. This is the Commercial Real Estate Show. We'll be right back. Hey there, thanks for checking out the Commercial Real Estate Show. Don't miss a video of special interest to you. Be sure to subscribe below. And if you appreciate the videos, be sure and thank our sponsors. There's a link to more information about them in the description. For more videos, podcasts, and articles, check out CREshow.com.